Let us see the next question. Following information is available of Messrs. TS Limited. Operating income is given 5 crore. Interest on debenture is given 1 crore. Earning before taxes is 4 crore. Income tax at the rate of 25% is 1 crore. Profit after taxes is 3 crore. Number of outstanding shares are 40 lakhs. That is 0.4 crore. Earning per share is 7 rupee 50 paise. Market price of the share is 75. Price earning ratio is 10 times. It is found as MPS upon EPS. TS Limited has undistributed reserve of rupees 8 lakhs. 8 crore. The company requires 3 crore for the purpose of expansion, which is expected to earn the same rate of return on the capital employed as at present. However, if the debt to capital employed ratio, it is if the debt to capital employed ratio is higher than 35%, the price earning ratio is expected to decline to 8 times and rise in the cost of the additional debt to 14%. Given this data, which of the following option the company would prefer and why? First option, if the required amount of the debt is raised through debt financing, if the required amount of the debt is raised through equity financing, new shares will be issued at the rate of 25 rupees each. That is a question. So that is the information. Everybody is requested to go through the question, please. So friends, over here, the question is about, we are going to raise an amount of 3 crore. And the question is providing the information that say you are required to decide that which option is better. Whether this amount should be raised through debt financing or through equity shares, that is a question. If at all we raise the additional funds by way of equity, then in that case the issue price will be rupees 25, like that information is given. Please write an answer. First point. In this question, we have to decide that whether to raise additional finance of 3 crore by way of debt or equity. Second point. Now friends, you have been provided with the information like this. If debt to capital employed ratio is higher than 35%, the price earning ratio will decline to 8. Like that information is given. It means that say we are required to make the calculation of market price of the equity share for both the options, because only in that case we will be able to use the information about the price earning ratio. So we understand second point. We have to compute market price of equity share, comma, for both options and option having higher market price of equity share will be selected. Full stop. Let us working note number 1. Calculation of number of equity shares to be issued, comma, in case of equity financing. We are going to compute the number of equity shares to be issued. So it is amount divided by issue price. The amount is 3 crore, that is 300 lakhs, divided by issue price is provided as 25 rupees per share. You can see that the amount is 3 crore and for equity shares the issue price is 25. So 300 lakhs upon 25, that comes to 12 lakhs. Please write down this answer. So now I want all of you to make the calculation of the MPS if at all we go for the additional funds by way of debentures. So if at all we go for the additional funding by way of debentures, then in that case what would be MPS? I want you to calculate it. Everybody is requested to write an answer along with me. I just explained that to you. First of all, we'll calculate the working note for calculating existing debt finance. We understand that it will be found like this. Interest is equal to debt into rate of interest. So debt is equal to interest upon rate of interest. What is the interest amount? Interest amount is 1 crore. Rate of interest is 10%. So we understand it is 1 crore divided by 10%. That comes to rupees 10 crore. Why do we prepare this working note? I just explained that to you in 2 minutes of time. Next, working note for calculating debt to capital employed for each of the option. That is what we are going to calculate. See, there are two options that we have. One is the debt financing and another is the equity financing. So we understand that's over here. So the first one is the debt financing and another is equity financing. We are required to make the computation of the debt to capital employed ratio because the question says that if at all the debt to capital employed ratio is higher than 35%, then in that case the price earning ratio will fall. So we need to compute that what is the debt to capital employed ratio for both the options. So we understand that, say, first of all we will have equity share capital, then we will have reserves and surplus, then we have existing debt, and then we have new debt, or we will have new equity. As far as existing share capital is concerned, you can see that, so the question is providing number of outstanding shares are 40 lakhs and it is rupees 10. So in that case it is 400 lakhs. So this is 400 lakhs. So it is 40 lakhs into 10. Reserves and surplus. You can see that, so the question is providing the information that the company has undistributed reserves of rupees 8 crore, that is 800 lakhs. Existing debt financing we already have found, it is 10 crore, that is 1000 lakhs. In case of the debt financing column, new debt will be an amount of 300 lakhs and new equity will be 0. On the opposite side, this is same 400 lakhs, this is same 800 lakhs, this is same 1000 lakhs. New debt is 0 and new equity will be 300 lakhs. That is the way we find the total, and the total is 400 plus 800 plus 1000 plus 300. So it comes to 2500. Over there also of course 2500. So debt to capital employed ratio, it will be found as existing debt is 1000, new debt is 300. So it is 1300 lakhs upon 2500 lakhs into 100. This is the way the answer is found, and the answer comes to 52%. On the opposite side, existing debt is 1000, new debt is 0. So over here 1000 lakhs upon 2500 lakhs into 100. So in that case also it comes to, I think, 40%. In both the cases, the debt to capital employed ratio is exceeding 35%. So we understand that, say, the price earning ratio will reduce to 8 times whether we raise the additional financing by way of debentures or by way of equity shares. Please write on this working note. Next, calculation of current return on capital employed. Return on capital employed. Let us see how to calculate it. It is earning before interest and taxes upon capital employed. Earning before interest and taxes is an amount of rupees 5 crore. So this is an amount of 5 crore, that is 500 lakhs. Divided by capital employed is consisting of equity share capital plus reserves and surplus plus debentures. So it is 500 lakhs upon equity share capital. We understand that it is 40 lakhs and 10 rupees. That comes to 400 lakhs. So 400 lakhs plus reserves and surplus. It is an amount of 800 lakhs plus debentures. That is an amount of 1000 lakhs. Whole into 100 for getting answer in percentage term. So we earn 500 lakhs on an investment of 2200 lakhs. Into 100 for getting answer in percentage term. So the final answer is 22.73%. Now why do we compute this? What is the requirement? Because the question is providing the information that additional financing of rupees 3 crore that we employ in the business is going to give you the same return as the return on capital employed right now. Because what happens at when you will expand your business, then in that case your earning is going to increase. Now what is the rate at which your earning will increase? For that clarification is made in the question. That the company requires rupees 3 crore for the purpose of expansion, which is expected to earn the same rate of return on the capital employed as at present. So whatever the rate at which you are earning right now, that itself is the rate at which you will be earning once you will expand your business. Like that clarification is made. So what will happen, friends? We understand something like this. When we will make the calculation of MPS, we know that there are two options. Either we raise the additional financing by debt or we raise additional financing by way of equity. So earning before interest and taxes. We understand that right now we earn rupees 5 crore. So this is 5 crore plus this 3 crore is also going to give some earning to you. What is the rate at which we are going to earn? 22.73%. So 3 into 22.73%, that is 0.6819 plus 5. So you will be having earning of 5.6819 crore, whether you are expanding the business by raising debt financing or you are expanding the business by way of equity financing. That is what we understand. So EBIT minus interest. In case of the debt option, what will happen? We will have two interest. One is the existing interest, that is an amount of 1 crore. Plus there is an additional interest. We understand that say the additional financing is an amount of 300 lakhs, that is 3 crore, and for that the rate of interest is 14%. So what will happen? 3 into 14%, 0.42 crore plus 1. So it is 1.42 crore. EBIT minus interest is EBT. It is deducted from 5.6819. So 4.2619. Income tax rate is given to us as 25%. So earning after taxes is 75%. So into 0.75. So 3.1964 crore. Divided by number of equity shares. In case of the debt financing option, it is going to remain same. 40 lakhs, that is 0.4 crore. So EPS 3.1964 divided by 0.4. So 7.991, that is earning per share. Price earning ratio. In case of the debt financing option, the price earning ratio will be 8. Why? Because debt to capital employed ratio is exceeding 35%. So we'll get the MPS 7.9910 into 8. That comes to 63.928 or 93. This is the answer of the first option. Please check down and try to do second answer on your own. Let us see how to do answer for equity. Amount of interest will be same 1 crore. EBIT minus interest is EBT 4.6819 crore. So 4.6819 into 0.75. That comes to 3.5114 crore. Divided by number of equity shares 0.52 crore. Why? Because we have computed the very first working note that 12 lakh equity shares are required to be issued. So 3.5114 divided by 0.52. That comes to 6.7527. 6.7527 multiplying with 8. So 54.0216. So 6.7527 multiplying with 8. That is the way MPS is calculated. And of course, the option which is having higher MPS is selected. So we will advise the committee to go for the debt financing. Please write an answer. The company is advised to raise additional financing comma by way of debt financing. Full stop.